In this video, I'm reviewing the number one 401k rollover mistake. You want to make sure that you avoid this at all costs. Hey everybody, it's Matthew Jackson here from 401k Maneuver. We provide online professional account management for your 401k with the goal of supercharging its account performance. So stop leaving money on the table each and every year in the form of lost returns. Let us help you. If you're new here, be sure to hit the subscribe button, and the links to everything that we mentioned in this video you can find in the description box below. So let's get started. If you're one of the millions of people who recently left a job, there's one thing that's worse than leaving behind your 401k with a past employer, and that's making a very costly 401k rollover mistake. More than 4 million people have left their jobs each month in the US so far in 2022, and data shows this trend isn't letting up. A report from McKinsey and Co published just this year in July of 2022 found about 40% of workers are considering quitting their jobs in the next 3 to 6 months. Whether you left behind an old 401k in the past, or you plan on leaving your employer that offers a 401k, you may not want to leave it behind. If you do decide to roll it over, it's critical that you understand your rollover options and plan your decision wisely. If not, taxes and penalties may take a huge bite out of your retirement funds. So keep watching to find out more about this number one 401k rollover mistake and how to avoid it. Okay, first thing you need to understand there's two types of rollovers, direct and indirect. A 401k direct rollover is exactly as it sounds. The transaction or transfer occurs directly between the custodian of your old 401k plan and the custodian of your new 401k or individual retirement account, also known as an IRA. You never actually receive the funds or have control of them, so a trustee-to-trustee transfer is not treated as a taxable distribution. There are no penalties or taxes that have to be paid with a direct rollover. You can roll over your old 401k directly into your new 401k, IRA, Roth IRA, and even an annuity. Indirect rollovers are where the mistakes may be made, mistakes that are very costly. With an indirect 401k rollover, you receive a distribution check from your 401k plan, and then to complete the rollover transaction, you must make a deposit into the new retirement plan that you want to receive the funds. 20% taxes are withheld from every indirect rollover, whether you plan to roll over the funds or use the money to pay off debt or make a purchase. The money for taxes is always withheld. And this is because the IRS mandates that your 401k custodian withhold this amount. So you get a check mailed to you less the 20% of taxes. When you get the check in the mail, you're required to put those funds in a new retirement account within 60 days. Remember that, 60 days. If you want to roll over your entire distribution, you'll need to come up with that extra 20% from your other funds to complete the rollover. You will be able to recover the withheld taxes when you file your tax return. But to complete the rollover, you need to come up with that extra cash. And if you fail to do so by the 60-day deadline, your distribution will be taxed as ordinary income and subject to a 10% early withdrawal penalty unless you're age 59 and a half or other exceptions apply. And this is where the number one 401k rollover mistake occurs. Should you miss the 60-day deadline or decide you need to cash the check to pay for the new roof, to pay down debt, or go on vacation, you will owe taxes plus penalties. That is, unless you're 59 and a half, because the IRS states this is when you can withdraw penalty free. However, you'll still have to pay taxes as ordinary income on the money. So let's talk about the true cost of this 401k rollover mistake. It's probably clear at this point how costly making an indirect rollover can be, even more so if you're under 59 and a half. To further our point, let's say you're 45 years old and you're in the 20% tax bracket and you have a $10,000 balance with your old 401k. Whether you missed the 60-day deadline to roll over your funds or you decide to cash it out, if you cashed in your 401k and you're under age 59 and a half, this is considered a distribution, and now you're taxed 20%, plus you'll pay a 10% early withdrawal penalty. That means 30% of your hard-earned retirement savings will go to the government, and you'll only get to keep $7,000. Check it out. That's $3,000 of hard-earned savings gone right down the drain. Aside from the money lost, there are long-term implications to missing the 60-day deadline and being forced to cash out your 401k. You're putting a dent in your future retirement income. Your money won't be working for you, and you will miss out on compounded earnings as well as tax-deferred growth. So before you roll over your old 401k, it's important to understand all of your rollover options before you make a move and seek professional help. Each investor situation is unique, and speaking with someone who can navigate the rollover process helps you make the best decision possible for your financial future. And your future self will thank you. Have questions about rolling over your 401k? Book a complimentary 15-minute 401k strategy session with one of our advisors today.